Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
Well, welcome back to the Emerging Managers Podcast. I'm your host, Scott Kelly, the founder and CEO of Black Dog Venture Partners. And I had a great interview with Matt Olivo, the founder of C2 Ventures. And he had a really interesting thesis that we haven't heard before. He discusses their investment strategy focusing on dirty, dull, and dangerous startups, which targets overlooked and underserved markets in fundamental industries like manufacturing and healthcare. Explains that these companies solve obvious problems with a clear and immediate ROI for customers, often led by founders who experience the problem firsthand. He invests in early stage SaaS and robotics companies, emphasizing true autonomy in robotics with the discrete use cases and viewing AI as an engine or a feature rather than the product itself. Vastly different than what you're hearing in the press lately. They maintain a disciplined approach to valuations, even during market bubbles, to ensure the power law model works for generating outperforming returns. And Matt also, highlighted the challenges emerging managers face in securing institutional investment and emphasized the value proposition of smaller, focused funds, which we're going to learn more about in this podcast and we've learned in other interviews. So give this interview with Matt from C2 Ventures a listen, and I'll be back with my takes. Hello, everybody. Scott Kelly, founder and CEO of Black Dog Venture Partners and your host for the Emerging Managers Podcast. And I'm excited to introduce Matt Olivo of C2 Ventures. Matt, welcome to the show.
Thanks for having me, Scott.
So, Matt, before we get into C2 Ventures, maybe share a little about your background, prior to launching the fund.
Yeah, so I was actually traditional Wall Street for, going to date myself here, but close to 20 years. Was a banker for about 12-ish, and then I was at a hedge fund for a few years, and I was a private company CFO after that.
Fantastic. So what's the genesis of the fund? Maybe share about the thesis, why you set up the fund, and, kind of share a little bit more about where you're investing and how you're investing.
Yeah. So my partner, Chris, and I, we're personal friends going back to 2015 or so. Just were chatting one day. I was looking to, for something else to do, from the role I was in at the time. And, he had done some angel investing and had done, pretty well with it. And, was kicking around the idea of starting a fund. And so I volunteered to help him out with it, as I had done that kind of structuring stuff in the past. And, one thing led to another. I think we decided that we had sort of similar views on the world and ideas of how to run one of these things. And next thing you know, we were launching our first fund in kind of the end of 2019.
Now, I looked, obviously, a little bit of homework. You say you invest in, I'm going to get the quote right, in dirty, dull, and dangerous startups. Tell me a little bit more about that.
Yeah, so it's, well, I guess I would say it's less the startups themselves. They're, SaaS and robotics, but it's the underlying kind of customer base there. And yeah, we when we launched our initial fund, we had, this was one of I think 2 different kind of focus areas that we had. And we quickly realized that this particular focus area was where the real opportunity was. So we made a couple of investments, elsewhere, but since those first couple, it's been all the dirty, dull, dangerous. The idea here is a couple things, right? One is that, America has had slowing productivity growth for quite a while, right? So we're probably 10 or 15 years in at this point. And we had sort of done some research on this, and it seemed to us that this was largely due to being underinvested in tech assets and in software in particular. To the extent that any of these big industries had dipped their toe in the software water, they had kind of done it back in like the 90s. Maybe it was early apps, but in a lot of cases it was internally built things. But software that basically hadn't been upgraded since then. A lot of stuff still even on-prem, not on cloud, et cetera, et cetera. And then of course, with robotics, which obviously has been around a while, but in terms of like it being sophisticated enough to have real practical applications, we saw that as another opportunity for these folks. And the other things that appealed to us about the strategy, right? One is these are products that sell themselves in a sense. I mean, I make that sound a lot easier than it actually is. But the idea being that unlike a lot of, admittedly cool new tech that's, I think, hard to sell because you have to convince people they need the product to begin with. And then you can convince them that yours is the version of the product that they, now think they need. These are all situations where it's a very obvious problem and it's very kind of clear, obvious, and immediate ROI for the customer. And in fact, actually, I'd say in most cases, right, at least 80% plus of the companies we've invested in, it's a founder who lived the problem and kept looking for solutions and finally got fed up with it and said, okay, I'll just build one myself, which is, great for any number of reasons. The other, which I'm happy to get into too, I don't want to go too long on it. The other, a considerably easier sales process. Actually, I'll steal one of our LPs said to me, yes, a lot of these folks will go out and build the world's, greatest hammer and then go looking for nails. Whereas we like to see it go the other direction where, somebody is so fed up with like, could someone please give me a tool to hammer these nails in, and they're not there. So They go build the hammer. Last thing on that. Well, so actually two other things on that. One is that the other thing that's nice is these are not sort of fly by night. This isn't Web3 or, some of these other kind of fad, sectors that popped up out of nowhere. These are gigantic industries. They're fundamental to the US and global economies. They're not going anywhere. Even in the most severe of economic downturns, manufacturing doesn't die. People still need healthcare services, et cetera. Last thing I'll say too is that now we're starting to see a bunch of other people throwing out sort of similar taglines and similar, we invest in boring industries, that kind of thing of late. I mean, within the last 6 months, we've seen a lot more of it. I will say it's still a very overlooked market or sort of underinvested market from a VC standpoint. So we're not, having to fight with, 10 other people over every new deal. And along those same lines, because of where these underlying customer segments are located geographically, they're a lot more in the middle of the country, in the South, Midwest, et cetera. So it's not quite the same kind of feeding frenzy that you get on the coasts as well.
Right. So you mentioned robotics. Where do you see robotics, having the biggest impact? What kind of industries are you seeing the trends where robotics are really, game changing, the industry?
Yeah, it's interesting. Well, so the obvious one is manufacturing, right? And robotics has probably been around the longest there. I will say with respect to manufacturing, I think it's less that robotics are new to them. It's more that the applications are becoming, there are more things that are being automated and the applications and the robotics, what they can, what they're able to do effectively and what they're able to do autonomously has just increased dramatically. So that's certainly one area. And then, a lot of the other areas, it's less about an industry. It's more about a specific application. So, okay. We've probably got, I should know this, but top of my head, call it 5, 6, maybe 7 robotics companies out of 60 or so in total across all of our funds so far. And we would do more of them, but every VC passes on considerably more deals than they invest in, but with robotics, we have to, I think, by necessity, I think personally, have to be more selective there because I think in a lot of cases, people, so as sophisticated as robotics has become, it still has a lot of limitations, right? So what we found to be the most interesting to us and the most effective in the market, at least from what we've observed, are very discrete use cases where you minimize as much as possible the edge cases. So I'll give you one example. We have a company that's called Somatic that does, by the way, if you Google Somatic robot, they have a bunch of really cool YouTube videos that will pop up. These are fully autonomous bathroom cleaning robots and for commercial use, right? So office buildings, hospitals, big manufacturing facilities, airports, et cetera. And what we really liked about the company and frankly about the founders, because they were very deliberate about this application. I think before they started Somatic, they had tried like a last mile delivery thing, and it was difficult to do. They were probably, too early at that point in time because, we invested in this company in 2020. And so this was probably back in like the mid-teens that they had done that original. But the reason they chose bathrooms and specifically out of all, well, a couple things, right? Cleaning in general. And I think this is true for the vast majority of robotics applications. There's a lot of kind of fear out there that like they're taking jobs. They're actually not taking jobs. They're or that people want or people actually are in. They're filling job openings, right? These are jobs that no one wants. That to the extent you hire people, there's unsustainably high turnover, et cetera, et cetera. So in this case, so cleaning was an obvious one as far as that goes. Why they focused on bathrooms was just because, again, there were far fewer edge cases, right? So if you think about, everything's nailed down, nothing moves in a bathroom, right? Everything is attached. Toilets and sinks and stall doors and that sort of thing. There is some variance, but there's 3 different ways that a stall door opens. Like their toilets all more or less sort of look and operate the same, et cetera. And frankly, I mean, having lived through that process, I think we sort of inherently knew that this was true. I think it's been reinforced, many times over based on just how many edge cases they had to deal with in something as discrete as that. So if you think about the difference between that and like even vacuuming a conference room, right? All conference rooms are laid out differently. Tables are very different. Chairs might move from day to day. There, people leave things on the floor. And so, yeah, I guess I went a little long on that one, but that's the idea, is that when you're talking about true autonomy, right, there's a lot of robotics products out there that dance around the fact that there's a human actually operating them still. If you want to look at true autonomy, at this point in time, at least, I mean, sure, it will evolve over time. It's, sticking to these cases where you're not going to have, you're going to have minimal human intervention. I think that's
right. So you obviously mentioned also SaaS. Where's AI playing in how you look at SaaS companies to invest in, and maybe even how you do your due diligence?
Yeah, of course. We have I think a slightly different take than maybe a lot of folks do on the AI side of things. Where no question, I mean, we full agreement with everyone on the power of the product, and we've had companies even before kind of the language based, the generative AI, the more sort of data predictive stuff that's been around for a while, that what people will alternatively call machine learning. We've had companies utilizing that for years. And as far as the language based stuff goes, so 2 things on that. One is that to the extent that there is a reason to use it, I think every company in our portfolio is currently using it. And we do have some companies that are sort of newer that would not be able to, like, their product wouldn't be able to exist. Like they're taking the power of that technology and actually creating a product that you couldn't really do before. I'll give you 2 examples again quickly. We have a company called Briefcatch that's in the legal tech space, and they use AI for improving legal writing language. So, the founder is one of the guys that would go to law firms and do seminars on effective legal writing and things like that. And he has this huge database that he started with of some of the best written legal briefs when it came to. So they started it with litigation and opinions by Supreme Court justices, and he had a whole scoring system for the effectiveness of their writing. And so the original version or the original kind of product there was as you're drafting a document, you could either ask it questions, or it would occasionally jump in and proactively say, hey, this language for this particular argument you're making would be more effective, and they'll show you the source, a Supreme Court decision by Justice whoever, in the past, that kind of thing. And now they've expanded that to where it can do more kind of drafting from scratch and that sort of thing. The other one I'll mention quickly is a company called Digital Iron. So they actually use the generative AI tech through a natural language interface to automate the diagnostic work for heavy machinery maintenance. So if you think about the giant cranes that you see all over, cities building, new high-rise buildings, that type of equipment, the dealer, who sold the equipment or is leasing it is typically the one responsible for maintenance. The manuals for these things are, thousands and thousands of pages. And so what the software does is you'll input what the user says is happening or what's not working, and it will instantaneously kind of read through the manuals and pull out diagnose the issue, and then it will take it a step further, and it will automatically go out and it'll identify the parts that need to be replaced and the maintenance that needs to be done, and then it will actually go out and find options for part replacements with delivery times and costs and that sort of thing, and automatically communicate that to the user. So anyway, back to your question though, it's so we see AI in pretty much every product we have. Where I think we kind of differ from the market is that we don't see AI as the product. We see it as kind of the engine behind the product, or even in some cases, maybe it's just a feature of a product. And that's an important distinction, I think, because a lot of these really big and heavily funded kind of agentic AI platforms where, they'll say that we can do anything for any industry. My view on that is that means they can't do anything for any industry, because, it's something that you have to have an internal tech team who needs to be able to spend months, sort of customizing it for their particular applications. And it's, if they don't do it well, no one's going to use it. Right. So I think the thing that gets lost here is that the person actually using any B2B SaaS product is by definition non-technical, and obviously there are exceptions, but I'm talking about the overwhelming majority of them have zero interest in having to learn something that's complicated. We found even simple SaaS stuff like, pre-AI in some of these products, the most important thing, like the functionality is, that's obviously, it has to be able to do the function that's advertised. But the more important thing is that the UI is simple and intuitive. And even more importantly, and this is one of the advantages of having people from the industry, it needs to really be effective, to really sell effectively, and to have high retention rates with this software. It needs to, the workflow needs to basically mirror what the user does on a day-to-day basis anyway, so that you can kind of seamlessly fit it into what they're already doing. And so, yeah, that's kind of our thing, is that AI has to sit within software. And we find that, it's most effective and it will sell most effectively and have the highest retention rates if it is already built off the shelf for to solve a specific problem or a set of problems.
So in terms of the current investing in the fund, what stage do you invest? Do you lead rounds? What's the average check size?
Yeah, so we're just at the kind of tail end of our second main seed fund, and so in that fund, we and like I said, seed. So right, so that's pretty early stage. We will lead rounds there whenever we can do it. That's a smaller fund because we're only 2 funds in, and in this market, you've got to kind of build up a bit more slowly than you might have in the past. So that's a $21 million fund. So our initial checks there are kind of in the $500,000 ballpark, and then we can double up there with follow on for those companies that we choose to follow on with. We have led. Out of the 19 companies we have so far in that fund, we have probably led 6 or 7 of those deals. There are a couple instances when, there were a founder wanted us to lead, but there were other VCs interested. So let's say it was a $2.5 million round. We're in for 500. There's VCs coming in at $1 million or $1 million and change. And I had to actually tell a couple founders, like, listen, you're not doing yourself a service by love the fact that you want us to lead. We'd love to lead, but you might lose. You're probably going to lose a couple of these bigger checks because the VCs tend to bristle at the idea of somebody smaller than them in a round leading. And so I just said, listen, if you want us to lead, we're happy to do it, but you're probably better off, with the others. So anyway, we'd love to lead all the rounds. I mean, we're out in market right now and hoping to close within the next couple months, or at least first close of our third fund. There, we're aiming to do at least 50 on that fund. I think the strategy scales up to 100 without us having to, to change strategy or to kind of change the profile, the investment dynamics, the valuations, and that sort of a thing, which I'm happy to get into more of that. Every time I see somebody announce a $250 million seed fund, it kills me, because you're either wildly overpaying for things, or you're not really a seed fund, or you do so much follow on that you're effectively an A fund and occasionally dabble with seeds, that kind of thing. So that's kind of the current, that's kind of where we currently sit. And then last thing I'll add is we a couple of years ago, we also launched an earlier, like a pre-seed fund that we call our tributary fund. And we've filled up our first one. We've just launched our just done an initial close on our second one there. The idea there is to do deals that are just a shade too early, where we'll do just a single $100,000 check there. And the idea being that, any follow-on would come from the main fund. That's actually been great. I think so our initial tributary fund, we did 21 investments, and literally just did the last one a couple months ago. So some of these are new, but of the older ones, we've already had 5 of them that we've now invested in out of our main fund. So it's been working pretty well there.
Awesome. Talk about the makeup of the LPs that have been in the first 2 funds, and obviously the pre-seed fund. Who are these investors? Not by name, but by where they fall in the ecosystem.
Yeah. So so our first fund, we had 2 or 3 larger family office types, and then the rest were all individuals, folks that we knew personally or knew from the industry or whatever. And absolute, by the way, just heroic people who I almost question their sanity. If I look back now at what they were buying into, like, you guys are amazing, and you're kind of crazy. I can't believe you gave us money based on how little you knew at the time. But yeah, so that was that fund. Our second fund was we probably had 60 to 70% of our LPs from our first fund re-up. And so that would have been the couple of family offices plus, most of the individuals. And then we added our first institutional investor in that second fund as well. Another hero in my book, because I'll get into the institutional space in a second, like how hard that is for emerging managers. But the state of Connecticut's innovation fund, they came in for about 10% of our second fund. So and then as far as the third fund, to get to 50, realistically, it's going to have to be mostly family offices, and we'll see about institutionals. But we've had folks that we've been talking to on the institutional side from fund 1, frankly, even, and of course, fund 1 was definitely going to be too early. And even fund 2, we thought we might catch a couple more of them. But they wanted to wait to see more traction, et cetera, which I think is the artful way of saying they want to see big exits. But the third fund, we thought maybe, given kind of the traction and given what you can see, at least in the performance of the first 2 portfolios so far, even before we've had a huge exit, couple smaller ones, but nothing sort of like returning half or the whole of the fund yet. We would have thought that we might get a little bit more, but it seems it's just gotten harder and harder, I think, from progressively, frankly, from 2019 and maybe even a little before that, to get institutional money into what they would call unproven managers or emerging managers. It just seems like that part of the market has gone entirely into, much big name managers, larger funds, et cetera, which I personally, we can get into it or not get into it. I don't think that's going to serve them very well from a performance standpoint. Given some of the crazy valuation reach and, FOMO investing that's gone on in those bigger funds, but it is what it is. So this, third fund will probably be largely family offices. I will say that where we've seen the strategy in particular resonate a lot, though, which has been great, is families that made their money in these dirty, dull, and dangerous sectors. As you can imagine, our particular thesis resonates tremendously with them, right? Because they've lived those inefficiencies. In a lot of cases, they still are. They still might have substantial shares in those legacy businesses.
I'm glad you brought up. You really kind of honed in on the emerging managers versus some of these mega funds. Obviously, that's the whole genesis of this podcast, is to in a field of 3,000 plus venture capital funds, a very small swath of large VCs get a large amount of the LP money. So and as you mentioned, they're not getting better returns. They're not getting better performance, from that standpoint. So for potential investors that are listening in to the podcast today, whether it be family offices, fund of funds, high net worth individuals, why your fund, why C2 Ventures, and why now?
Great questions. By the way, you can add yourself to the list of heroes for putting a spotlight on the intrepid emerging managers here, because I think if you ask me, that's where the value is in venture, and always has been, frankly. I mean, all of these giant mega fund folks, when they were really building great track records, and don't get me wrong, they did a great job of it. It was doing what we do now with these smaller funds. But, with some exceptions, I would shout out Union Square Ventures, for example. I don't think they've ever raised a fund over 150 million. Like they kind of get it that but these other folks that just, can't resist the money, the management fees, whatever. I just think you're distorting the model to a point where I can't honestly see how the math works. I'm actually going to write. We have a monthly newsletter if people want to check out. It's on Substack. It's called In the Trenches. And I'm actually writing about just sort of laying out the math of why, the model works for early stage and it doesn't work for later stage. And this idea that like just be in the best companies, who cares about valuation, is kind of insane for a professional money manager. Right. And it really doesn't matter. You could be in all the best companies, but if you pay too much for them, you're still not going to have returns like it.
Right. You can absolutely overpay. That's for sure.
Yeah. I think why us, why now? The thesis would be definitely one of those pillars. There was actually a point in time, I'm sure probably you and every emerging manager has the wake up at 2 a.m. and go into the existential dread thing. One of my intrusive thoughts one of those nights, probably 2 or 3 years ago, was what if all the problems get solved and we run out of applications? And that's now my reaction is what you just said. No, that will never happen. There will always be more problems. There will always be better software. That whole thing. So I think, from that standpoint, there's just so much opportunity. Like I said, these are the products that are such obvious use cases and such clear and immediate ROI to customers that they're always going to sell. I think that's part of it. Certainly at this point, I think anybody who wants to kind of do a little bit of legwork and look at the companies that we've invested in and how they've fared so far. I mean, we're still only our oldest investments from our first fund are just now at like the 6-year mark, and a couple of them are kind of getting, folks are poking around, looking for acquisitions. But our second fund, right? I mean, we have, we made our most recent investment in that one 3 weeks ago, right? So it's, still early, but you can still see kind of I think how we select and how we kind of stay focused on that thesis, and not just kind of the dirty, dull, and dangerous, the high level part, but really focused on narrowing that down to the companies that are solving the biggest problems, that again have the most immediate ROI to customers, and folks that have know the industries inside and out, understand the day-to-day user, have connections in the market, et cetera, can walk into a meeting and anybody in the industry with instant credibility, right? I mean, if as opposed to the sort of stereotypical 20-year-old who dropped out of college to go, build his awesome new tech company, which, it works for some types of products, clearly. And you could rattle off a bunch of names. For this type of, I think, B2B SaaS thing, I just, that profile doesn't really work. So anyway, our kind of focus on that. And then to bring the valuation thing back up again, I mean, you can go look at the prices we've paid. I mean, I think we, even through 21, 22, crazy bubble periods, we were paying, 11, 12, maybe 13 million post monies on average for these companies. So, really staying true to what makes that kind of power law model work, that, that big upside that you're looking for, that you kind of need, to generate sort of outperforming or to generate outperformance, I should say. And I was writing stuff about this. Actually, it's funny. I think I've called multiple bubbles in my career, going back to when I was in traditional finance. I'm always like a year early. So I think we're in an AI bubble. So there's probably another year to go on that too. Because it's funny. I was talking to a prospective LP about this, and they said, "Oh yeah. Well, let me go see your." I was saying like, "Hey, we're not just saying that we didn't chase things in 2021, we actually we're writing about, kind of sort of these, is anybody else seeing this? How are we the only one seeing this kind of a thing?" And so they went, they asked me for the link, and I went back and looked, and it was actually like in January of 21. So, I mean, again, the bubble probably 2 or 3x from that point. But yeah, I would say that kind of, adherence to just being disciplined. Listen, this is an incredibly high risk space to invest in to begin with. Like, you don't need to compound that by overpaying for things, by chasing, companies that are outside of your core focus, that kind of thing. I mean, it's funny to hear probably to hear a VC say this, but we think a lot about like minimizing risk here, we try to stay away from binary outcome type things where, you have a company that if 5 things go right, it's definitely going to take off. But if one of them goes wrong, they're out of business in 6 months. I mean, it's just, there's so many good opportunities out there. There's no need to, to take on even more risk than you actually need to take on. So
really interesting. You mentioned, a year away. I was a banker and entrepreneur during the dot-com boom in San Francisco. And, this has the feel of 1998. So I would agree with your thesis that things will get interesting in a year from now. And maybe not in a good way. Any final thoughts you want to share with our listeners today?
No, I mean, I could talk about that. Just the bubble thing. I think it's interesting. So 98, for sure. I agree with that comparison. I just started at my first kind of banking job in 99. So, with again, like a year and change to go on that bubble, it definitely has a lot of resemblance. The other thing that I think is an underappreciated risk, is the, if you go, a few years past that, is what happened to search, right? So if you look at early search, right, it was GeoCities and Lycos and Yahoo. And if you look at there's actually a really cool, I don't know if you can Google it or try to find it. There's a really cool YouTube video that somebody put together where it's sort of, they're showing the leaders in search by year, and you just see it by quarter, and you see it just going up and down and up and down. And then all of a sudden there's Google at the bottom. And it just goes up and up and up and up, and everybody else just, and I think we run a very, very high risk of that happening with the kind of LLM models, where somebody comes out with some brand new way to build these things and maintain them, that is significantly more capital efficient. And, I've said this to people before, and they say, "What is it?" And I'm like, well, that's the point. I have no idea. Like, it's going to come out of nowhere. Like, no one knew what Google was until Google came out of left field with a brand new algorithm that was so much better than what was out there, and ate everybody's lunch within a couple of years. I think you're at serious risk of that happening. Frankly, I'm getting to the point now where I think it's going to happen, because the amount of money it takes to build and maintain these things is you probably can't just keep burning billions of dollars a year. Like, it's just, at some point you run out of money. So.
Yeah, I find the theory of spending trillions of dollars to make billions just isn't good math.
I couldn't agree with you more.
So where can people learn more about C2 Ventures, get in contact with you, and even sign up for your Substack? Yeah,
of course. So like I said, it's C2V in the trenches is the Substack. Love to have people check that out. Obviously, our website is c2ventures.co, no M there. And LinkedIn and whatever, we're on that. We have a lot of you'll see a lot of our kind of company news, and we share a lot of our, we'll have summaries of newsletters and our thoughts on various things pop up there from time to time. But please reach out to us through any of those mediums. Love to talk to any and all founders and any and all potential LPs. Fantastic. For those listening today, I encourage you to like, comment, and share this podcast. And again, Matt, thanks for being on the show. Appreciate it. Yeah, thanks for having me, Scott. Welcome back. As we learned during the interview with Matt, he's focusing on these dirty, dull, and dangerous industries. And
the great thing is that they're underserved by traditional VCs and the larger VCs. Gives them less competition for deals at potentially much better valuations. And again, as we discussed during the interview, he's a clear ROI and founder expertise. They're founded by investors and individuals with deep industry knowledge. And he has a disciplined approach to valuation, and making sure even during market bubbles, this approach to valuation helps ensure better potential for more significant upside returns. And, and it was interesting. He mentioned the emerging manager landscape. And honestly, as you know, if you've listened to my podcast before, that's the whole thesis of this podcast, is casting a light on these emerging managers, these smaller funds that are better positioned for better returns and generate better value for venture capital compared to larger mega funds that may overpay for investments. And, the one thing that was resonant throughout the interview is his investment thesis. It particularly resonates with family offices who made their money in these traditional industries and understand the efficiency. So he's taking these dirty, dull, and dangerous businesses, buying them at great prices, and bringing investors that understand dirty, dull, and dangerous businesses. So if you're looking for something a little dirty, a little dangerous, maybe a little dull, and want to make some great returns, take a look at what Matt's doing at C2. And we've got plenty more great emerging managers like Matt coming up. So I encourage you to like, follow, share, and tell your friends to listen in. Thanks again. We'll see you soon.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers Podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.